The Economic Democracy Act, democratizing the money system for universal basic ownership. How it works. The Economic Democracy Act, EDA, is an economic plan and proposed legislation to create equal capital ownership opportunity for every citizen from birth to death. It would enable have-nots to become haves without taking away wealth from current owners. The EDA would accomplish this by reforming today's ownership-concentrating money system to make it more inclusive, accountable, and responsive to the growth needs of private sector businesses. Within a democratized money system, every citizen, adult and child, would gain equal access to the means to own and control new growth capital, including the most advanced technologies, and gain a new source of income. The following diagrams explain how every citizen could obtain new asset-backed money and interest-free self-repaying capital credit through the commercial and central banking system to purchase dividend-paying full voting shares of growing companies. Step 1. Each year, annually, biannually, or quarterly, the government estimates how much productive capital will be added to the economy in the coming period, both in the private and public sectors. We can calculate each citizen's annual allotment of interest-free insured capital credit by dividing the total dollar amount of projected annual capital formation to be financed through the sale of new shares by the total number of U.S. citizens. Step 2. An enterprise that needs to acquire new capital assets, such as land, equipment, structures, patents, information technology systems, etc., decides to finance that new capital by selling newly issued shares to citizens at their current market price. In this example, a family of 4 goes to their local bank to set up 4 individual tax-sheltered capital ownership accounts. With the parents making decisions on behalf of their minor children, they will get investment advice from the bank or other financial advisor and use their annual capital credit allotments to purchase qualified shares of the enterprise. Step 3. The company promises to pay annually, biannually, or quarterly to each citizen's capital ownership account all the profits earned on the shares to be purchased. The initial company dividends are first used to pay off the scheduled EDA loans. If the citizen receives dividends above the periodic payments due on their EDA loans, those additional dividends may be paid to them as personal taxable income. Shares are not taxed as long as they remain in the capital ownership account. Step 4. Citizens deliver bills of exchange to their bank for approval and acceptance for receiving that period's EDA loans to purchase their selected shares. A bill of exchange is an agreement which can be written by the lender stating that the citizen will use their EDA capital loan to be made through the local bank to purchase their selected qualified growth shares. Before the EDA loan is made through the citizen's capital ownership account, the lender, risk insurance company, and other entities will first determine the feasibility of that specific loan. Feasibility means that the enterprise's new capital is expected to generate enough future earnings to pay off the loan to purchase the capital. In the case of EDA loans, the new capital asset must be able to pay for itself within 3 to 7 years. Step 5. The bank guarantees to a capital credit insurer to add a risk insurance premium to the loan for purchasing the citizen's new shares. Capital credit risk insurance, under the Economic Democracy Act, serves as a substitute for conventional forms of collateral what lenders seize if the loan cannot be paid off. The collateral requirement has been one of the major barriers for non-wealthy people seeking capital loans. The EDA loan's one-time risk premium and other service charges will be covered with the bank's discounting of the EDA loan. The bank discounts the loan by keeping for itself a percentage of the total loan that the customer must pay back. The total of the EDA loan principal and all loan costs is paid off with future dividend payouts spread out over the life of the EDA loan. Step 6. The capital credit insurer insures each of the EDA loans, assigning appropriate risk premiums. All shares to be sold through the EDA program must first be vetted for their feasibility by investment banks, commercial banks, and capital credit risk insurers before qualifying to be sold to citizens. The riskier an EDA investment is, the higher will be the premium for the capital loan insurance and discount charged on the loan. 7. The local bank bundles or transfers to a capital credit syndicator for bundling all insured EDA loans. Lenders may bundle, add together loans, so they don't have to handle a lot of separate transactions. The bundled EDA loans will be taken to the Regional Federal Reserve Bank's discount window for the central bank to issue new asset-backed money in the form of currency or demand deposits, the local bank's checking account at the regional Fed bank. Step 8. Either directly or through the capital credit syndicator, the bank takes the bundled EDA loans to the discount window of its regional Federal Reserve Bank for rediscounting. Rediscounting is when the regional Fed bank takes its share from the total EDA loan, an amount to cover its own servicing costs for issuing new money. Thus, the total EDA loan to be repaid includes the amount of new money created for purchasing new shares plus all loan charges. Step 9. The regional Fed issues to the local bank a promissory note and creates new asset-backed currency or demand deposits, a checking account for the local bank. Like the promissory note, an IOU, that the local bank issues to a borrower, the Regional Federal Reserve Bank issues a promissory note to the local bank, making the loan to the borrower. In the case of the EDA loan, the legal borrower is the citizen's capital ownership account, which protects the citizen's assets outside the COA from being seized if the loan goes bad. Step 10. The local bank then transfers to the citizen's capital ownership account, COA, the new money to be used to purchase the newly issued shares of the enterprise. Depositing the new money in the citizen's COA ensures that the newly created money is used only for purchasing the citizen's selected qualified shares. The new EDA created money and credit cannot be used for consumer or other purchases. Step 11. The citizen transfers the new money from his or her capital ownership account to purchase the new growth shares of the company. This is when the new asset-backed money being held in the citizen's COA is paid to the company to buy its new shares. Step 12. The company uses the cash to purchase new capital assets and working capital. Step 13. The enterprise puts into operation the new capital, technology, structures, land, etc., to increase its production of marketable goods and services. Step 14. As it generates profits, the company makes scheduled payments of dividends to the citizen's capital ownership account. These dividends are tax-deductible to the enterprise and aren't taxable to the citizen if those dividends are used to pay off the citizen's loan through the COA. Step 15. The capital ownership account makes periodic installment payments on the citizen's EDA loan. Once the total amount of that loan is fully paid off, all additional future dividends become a new source of taxable consumption income for the citizen. Step 16. The money creation cycle within the economic democratization process ends with the original money being canceled. This prevents the inflationary effects of having money in the economy that is not backed by capital assets or marketable goods and services. Summing it up, by creating new money only for productive private sector growth projects and not for government spending or Wall Street and other forms of speculation, there won't be too much or too little money in the economy. New money, whether in the form of paper or digital currency, demand deposits, etc., will be backed by new capital assets we'll own and real marketable goods and services we'll buy, and not by ever-increasing government debt. By channeling the new asset-backed money and insured interest-free capital credit through ownership democratizing vehicles like COAs, all new production will be matched by new consumption incomes. More and more people will gain income and purchasing power generated by their capital assets. By democratizing access to money power to every citizen, we will also democratize ownership of and accountability within the money system itself. When we systematically spread economic power to every citizen, we will automatically spread power throughout our political democracy as well. And as every citizen everywhere gains the means to invest in environmentally responsible technologies and processes, we can allow our planet to flourish along with each of us as human beings. For more information, visit the Center for Economic and Social Justice at CESJ.org.